Okay, today we will discuss the cash flows, but now we will discuss the direct method. And this method is a bit tricky method, and students, most of the students do not like it, or we may call this that most of the students do not perform true calculations or correct calculations in it. But the key is the understanding and the concept, and if it is correct, then you will be able to do this correctly. Now, what this method, direct method, implies. In direct method, we match P&L items with their corresponding balance sheet items. And then we take the impact of cash either received from the customers or any other activity, and either we take the impact of cash payments. The only difference between direct and indirect method is of that of operating activities, investing and financing activities, and their working will remain same. So the operating activities will be divided into these two components, that is cash receipts and cash payments, or in short, we may call it that the working capital changes of the indirect method is split into the cash receipt and cash payments in the direct method. Now, how these P&L items and balance sheet items are matched? Let's look at them one by one so that our concept is clear in this regard. First, I talk about that is the P&L starts with the sales. Now, you imagine that from sales, which balance sheet item is related. This pertains to the very basic entry that we learned in the double entry system in the journal entries. That is, whenever sales are made, they are always credited. And if they are on cash, then cash is debited. Otherwise, if they are on credit, then accounts receivable is debited. So from here we get a clue. We get a clue that accounts receivable, the P&L item of sales can be matched with the accounts receivable also. Since cash is on the transaction is in cash, and we are also making the cash flow statement, therefore the cash will not be matched. Cash will be arrived at the net cash flow or inflow or outflow, as we see in our earlier indirect methods. So the sales item of the P&L is matched with the balance sheet item of accounts receivable, and from them the cash impact is taken. How it is taken? Obviously, through T accounts, our working will be made easier. Now we will make accounts receivable T account in this. Now see this carefully. We will be making accounts receivable T account, and as you know, if it is asset, opening will be written here, and closing amount will be written here. Fine. Then if sales are made, then entry is made accounts receivable debit and sales credit. It means that accounts receivable are debited, then the T account will be debited with the amount of sales. And unless and until it is stated otherwise, the P&L balance of the sales will be treated as credit item on credit sales. So we will debit T account with the sales amount. Now that we will total it this side and balance it, and we will minus this from the closing balance. The remaining balance will appear here. And in this way, you can see that accounts receivable account is being credited. And when it is account receivable is credited, yes, it is credited when we receive an amount. So after receiving an amount with the account receivable, we make entry that is cash debit and accounts receivable credit. So this is the cash received from the customers. And this amount will be shown in the cash flow statement in the operating activities of the direct method. In this way, we can calculate the cash received from the customers. That is how much cash has been inflow in our organization from the credit sales. As contrast to the indirect method, what we did in indirect method, we did just the difference of the account receivable. But in this method, in the direct method, we match the accounts receivable balance sheet item with this corresponding P&L item, and then we have made perform the calculations, and then the cash amount is arrived at, and that will be reported in the cash flow statement. Similarly, we have got another balance sheet item, liability item, that is accounts payable. Obviously, accounts payable pertains to the purchases. Since we are purchasing and we have on credit and we have to pay later, therefore now we will calculate or we will see how much amount have been paid on the accounts payable or how much amount have been paid on the purchases. And the main purchases of the working capital or the current assets is for the inventories. So there will always be involvement of inventories as well. Let's suppose we haven't given the purchases amount. Then how we will calculate it? We will calculate it through the cost of goods sold. And how cost of goods sold is calculated? You know that cost of goods sold is calculated as cost of goods sold is equals to opening inventory plus purchases minus closing inventory. So in the balance sheet, we might have given these two figures, opening inventory and closing inventory, as in the case of accounts receivable. So by putting this opening inventory and closing inventory in the amount of cost of goods sold, we can calculate the amount of purchases. Now this is the amount of purchase, and this purchase pertains to the accounts payable. Then after calculating the amount of purchases, we will be able to find out how much amount has been paid to the accounts payable, that is creditors. So its T account will look like this. Accounts payable is a liability, then liabilities opening balance will appear at the credit side and closing balance will appear at the debit side. Then what entry is being made when we purchase items? That is purchases debit and accounts payable credit. So it means that with the amount of that purchases, accounts payable T account will be credited. And again, we will balance the T account. We will add up these two and we will subtract it from this. Then the remaining amount will be left over on the debit side. And this would be always when we will pay to the creditors. We always make the entry since accounts payable is a liability and it is decreasing. So it will be debited and cash will be credited. So here accounts payable is being debited and it is debited because of the cash payment, and therefore this amount will be reflected in the cash flow statement as the accounts payable to the purchases for the cash paid to the creditors. Similarly, if we have any other payables, relating to expenses, then we also have to perform the calculations in direct method. Let's suppose we have been given some tax payables, that is, let's suppose we have 2 years, that is 2020 and 2021, and in liability sides we have a tax payable amounts dollar, let's suppose 500, and in 2021 it amounts to dollar 570 something. And simultaneously in profit and loss account statement, income statement, we have been given income tax expense of $20 for the year. Then obviously we have to calculate the tax paid to the tax authorities, tax paid to the government. In this case, working would be again simple. We will be making the T account of tax payable. Opening liability, opening on the credit side, 570. Sorry, 500. And credit 570. Expense for the year is 20. Now, whenever expense arises on the basis of accruals, that is payable. So we make entry of income tax expense debit and income tax payable credit. So income tax payable credit means it is 20 amount will be credited here due to the expense because we are making the T account of tax payable. According to the entry, income tax payable is being credited. Now we will balance it. 520 minus 570. There is a reversal weight. Let's suppose this is the amount. Tax expense is 100. So we will write here 100 and it is 600. 600 minus 570. So tax paid would be $30. And this amount, tax paid, will be reflected in the cash flow statement in the direct method. So how this will be, these workings will appear in the cash flow statements under direct method. We have to make calculations of the amount cash paid to the authorities, cash received from the customers, like that. Similarly, if there is expense, this is expense pertaining to the liability. But there are certain expenses pertaining to the asset as well. That is what we call the prepaid expenses. We have to take the cash impact of this as well in the direct method. How they will work? Again, a simple T account to understand this functioning. That is, let's suppose we have prepaid rent in the balance sheet given. So if we make the T account of the prepaid rent, so opening amount will appear here and closing amount will appear here because it is asset. Now we have given in P&L income statement an amount of rent expense as well. So under the domain of, now listen this carefully. Under the domain of prepaid and expiration concept that we learned earlier, whenever prepaid is expensed out, we make entry of rent expense debit and that prepaid credit. This entry we used to made in the adjustment of the prepaid. So prepaid rent is being credited. So we will credit this T account with the amount of expense. And again, we will balance this T account by adding these two amounts and lessening this amount of the opening. And the remaining will be the cash paid in respect of that expense in the context of the direct method. So these are some of the workings that we need to incorporate in the direct method of the cash flow statements. The remaining investing and financing activities will remain same. So there is nothing about discuss it as we had discussed it earlier. Now let's take an example or we will solve a question for that so that you have a clear understanding of the direct method. This is the question. In which we have to prepare cash flow statement under both circumstances. Prepare a cash flows during the indirect method that you will be performing yourself. I will make it from the direct method. Direct method cash flow statement, operating activities. Our focus is on operating activities because the investing and financing activities are the same. Now, for operating activities, what we have to do, we have to calculate the cash received from the customers and cash paid to the customers. Nothing to do with this thing because it will reflect our result. That is how much cash has been increased or decreased during the period. So from 2016 to 2017, 23,925 minus 43,050, our cash has been increased. Our net result is 19,125. This would be our result at the end. Now preparing a statement of cash flows from the direct method. We will make first accounts receivable T account to know the amount collected from the customers. So accounts receivable T account will be reflected in this way. Opening, opening 2016, 39 to 85, and closing 34, 125. Make sure you are putting the correct amount in the opening and closing area because sometimes the opening is given at this area, that in this column, and the closing in this column. So be sure about which column pertains to the opening or closing, or it may be very helpful if you write at the beginning that this column pertains to the opening and this column pertains to the closing. This would be very helpful. Okay, closing amount 34, 125. Now in the direct method, we put the sales amount. Sales amount in the debit side of the accounts receivable T account, that is accounts receivable debit and the sales credit. So sales is 446,000, and for our surety confirmation, we can also check this that all the sales are on credit basis. If some sales are on cash basis, we will subtract it and then we will insert the net amount. So all accounts payable results from the inventory. Okay, fine. Inventory purchases are on credit. Sales are all sales are made on credit. There is no cash sales, so this all amount will be debited in the accounts receivable account 446,100. Now we will balance that account. So 39,285 plus 446,100 is equals to 485,385 minus 34,125. Amount collected from the account receivable, that is cash, is 451,260. You can also recheck it. That is that the correct amount or not? Okay, there is a slide of transposition error. This is not 285, it is 39,825. And so resultantly, this amount will also change if we recalculate it. Is 39,825 plus 446,100 minus 34,125. It will be 451,800. Done. So this amount will be shown in the balance sheet, sorry, cash flow statement of operating activities under direct method. Now the second is inventory. This inventory is given for the purpose of calculation of purchases because we have given the cost of goods sold. So from these amounts, we can calculate purchases first. Then we will make the accounts payable T account and we will calculate the amount paid to the suppliers. So for cost of goods sold, sorry, purchases, cost of goods sold is equals to opening inventory plus purchases minus closing inventory. Cost of goods sold is equals to triple two $300. Triple two 300. Opening inventory is 146,475. Purchases that we have to find, that is X, minus closing inventory is 156,000. So if we find the value of X, that is purchases, it amounts to, you can apply your calculations, 146,475 minus 156,000, 9525, that will be added, triple two 300 plus 9525, 231,825. This is the amount of purchases. Now we will make the T account of purchases. Accounts payable, opening 33,750, closing 28,800. Now, if we look at the amount of purchases, so purchases are debited and accounts payable are credited. So this will be the T account of accounts payable will be credited with the amount of purchase, that is 231,825. And the remaining part of the T account reflects the cash paid to the suppliers for the purchases. It will be 33,750 plus 31,825 is equals to 265,575 minus 28,800. 236,775 will be the amount paid to the suppliers. Okay, we are done with the two major calculations of the cash received from the customers and cash paid to the suppliers. Now, in the second phase, we have to see whether there are some expenses in the asset side, prepaid expenses, or some outstanding expenses at the credit side, liability side, so that we can perform the calculations of them as well. So, and we have to see their corresponding P&L items. So if we see here, that is income taxes payable, and obviously we have got the income tax expense. So we have to perform the working of tax paid to the tax authorities. Similarly, if we see of the prepaid expenses, so they are majorly the operating expenses, and we have got the amount of other operating expenses as well. So we have to perform two more calculations for the direct method, that is the payment for the expenses from the prepaid and payment for the liabilities for the accrued liabilities, accrued expenses. So we will make first the account of prepaid expenses. Opening 1650, closing 3,600. Now, whenever expense has been debited, prepaid is credited. So our T account of prepaid will be credited with the amount of expense 120,300. So we will credit it 120,300, and the remaining will be the referred as the cash paid. So 120,300 plus 3,600 minus 1,650, 122,250 will be the cash paid for the expenses. This amount will reflect in the cash flow statement under the direct method operating activities. Now we will make the account of income taxes payable to ascertain how much tax we have paid to the tax authorities. That is, it would be tax payable. Opening, it's the liability. Opening will be here. Tax payable 4425. Closing 5,100. Tax expense is debited and tax payable is credited. Tax expense 13,725. No matter it is in positive or negative, but we have to credit that the tax payable T account 13,725. The remaining amount is the tax paid. We can calculate it easily. 4425 plus 13,725 minus 5,100. It would be 13,050 is the amount we have paid to the authorities for the tax purposes. So we are almost done with the calculations of the direct method, but one thing which we used to do in the cash flow statement to make sure that the dividend amount, retained earnings amount, and net income are reconciled with each other, we perform the T account of the retained earnings as well and put the net income in the credit side and the dividend amount in the debit side. If we look at the additional information, we haven't been given the amount of dividend paid or dividend declared. It means it will come through the retained earnings account. This is the first thing which we had learned. But similarly, if we see in the liability side, there is a huge line item, dividend payable. And if this is the case, dividend payable, then we have to perform one another calculation through the T account to arrive at the actual amount of the dividend paid. So how it will be worked? It will be worked first initially with the retained earnings T account. We have got retained earnings opening 62,100 and closing 108,000. Now we know that net income for the current period is 6150. We will write it here 6150. Now if we balance the T account, the difference is on the debit side. It will be the dividend amount. Now this dividend is for the year X, you may call it expense or dividend declared, that needs to be paid. So dividend is 62,100 plus 6150 minus 108,000. It is 14,250. This is dividend declared and payable. But we have also another payable at the opening of 4,500. So how much dividend is paid during the year in the form of cash? For this, we have to make the T account of dividend payable just like as the income taxes payable we have made it earlier. So dividend payable will be appear like this. Opening 4,500. There is nothing in the closing, so it will be closed off. Now, since it is a dividend, it's a liability, it is a payable, accrued. So it would be dividend expense debit and dividend payable credit, payable credit. So this will amount, since retained earning is debited, so payable is credited, that is dividend payable 14,250. And in total, 14,250 plus 4,500 makes 18,750 dividend payable debit and cash credit. So this is the amount of the dividend paid that would be reflected in the financing activities. So in this case, if we have got the dividend payable amount or line item in the balance sheet, we have to calculate dividend in the two stages. Okay, now let's quickly go through the other items for the investing and financing activities. This is the total current assets, equipment, accumulated depreciation, equipment. From this, we can easily get to know that the organization is following straight line method and the calculations for the depreciation is simple. You can calculate it. Income taxes payable, we have done. Dividend payable, we have done. It is the bonds payable, that is financing activities. We have paid off from 37,500 to nil. We have paid off the 37,500 liability cash outflow. Common stock, $10 par, we have not issued a single common stock, therefore there will be no cash impact in this. Loss on equipment, loss on retirement of bonds, adjustments, that will be directly in the cash flow under the indirect method of trading activities. Okay, and this loss on sale of equipment can be done through the calculations as well, because we have given the sum of the additional information regarding the equipment disposal. So you can easily prepare it. There is nothing to worry about. Let's quickly see about the presentation of the direct method. This is the indirect method. You can also tally with your answer as well. Direct method is like this, simple. Cash flow from operating activities, that is the only main difference between the direct and indirect method. Cash received from the customers, cash paid to the suppliers, cash paid for the operating expenses, and cash paid for income taxes. No adjustments of depreciation, no adjustment of gain and losses, and that's it. These are the four line items. And if we have no operating expenses or no income taxes payable, then these line items will also not appear. The only calculations will be of cash received from the customers and cash paid for the inventory. Now, cash flow from investing activities and financing activities will remain same. So this was the simple discussion of the direct method. And now you can do this comprehensive question with both methods again and check your calculations as well. But the difference is the making of the T accounts in the direct method.